They say you got to come out and say it, and we are today. Here are 3 reasons the market lows are in. And just so you know, this came out on November 13th on mapsignals.com. Let's go ahead and get to it. The first reason we believe the market lows are in is because interest rates have peaked. This is a beautiful chart highlighting the inverse correlation between the stock market, S&P 500, and the 10-year Treasury yield. As yields go up, stock market has some trouble. When yields start to fall, you start to see stocks start to perk up again. So if your portfolio is starting to shine, it's due to lower interest rates. Now, we have 4 data-driven reasons of why interest rates are going to stay below 5%. I'm just going to read this out. You need to literally sharpen your pencils, write this down. The Fed is likely done hiking rates, basically because Goldilocks growth and falling inflation. There was a beautiful CPI report that came out this morning. Again, it continues to head lower, stunning the crowd. Fears of 10-year Treasury supply gluts, that has eased. Why? Because the Treasury Department, they announced that they favor short-term bond issuance starting in 2024. Positioning, shorting long bonds worked so well for so long, became a very crowded trade. Now yields are falling as positioning normalizes. The long-term interest rates have historically also been very stable when inflation is running between 2 and 4%. That is the drop that we are seeing right now. CPI just broke lower and it is right near 3%. But here's the deal. When CPI is between 2 and 4%, it doesn't really do much to 10-year US Treasury yields. In fact, the next 12-month change is only 1%. So everybody talking about 13% interest rates. You remember that last month? Listen, it is a tale as old as time. Don't believe it. Let's keep going. The number 2 reason that the lows are in has to do with the most fundamental vector of all, and that is earnings growth. Here we see that earnings growth is now re-accelerating. You can look at prior times, right? 2009, when earnings trough started to accelerate. Also, remember COVID earnings trough, they started to accelerate. We're seeing that right now. Stocks follow earnings. Earnings are going up. Where do you think stocks are going? It rhymes with up. Okay, let's keep going. And just to drive this home, stocks shine in years after bottom quartile EPS growth. What in the heck does that even mean? Well, whenever you go from negative EPS growth to positive EPS growth, that puts you in this bottom quartile. So going back to 1977, 12 months later, during the worst estimate for EPS growth, stocks go up 13%. It's hard to find anything bearish when the macro is improving. So the third reason, oh my gosh, of why the lows are in is because we've been telling you that stocks were oversold. That's when this yellow BMI is below 25%. It rarely happens. And when it does, it's a time to be greedy for stocks. It's starting to explode higher. The last couple of times it did that, stocks went on a humongous rally. Holy moly, don't follow the crowd, follow the big money. So how do you play it, right? You're watching a free YouTube video. Well, check it out. Mega cap tech is seen powering those 2024 S&P estimates, okay? The first group is expecting a 17.1% earnings growth. That's communication services. Healthcare up 16.1%. We like technology, 14.6%, and we also like discretionary, 13.7%. But that isn't enough for you to just get bullish on those areas. Let's also look at what happens when the BMI is oversold. What groups tend to rally the most a year later? It's technology, 27% gains. That's the average. Number 2 is discretionary with 18% gains. Listen, there's a lot of feathers in the bull's cap right now. So let's bring this all together. If you're a bear, we are sorry to hear that. If you are a bull, consider Getting long, great, high quality technology stocks. Discretionary has a lot of names that are really, really attractive. And again, if you want to look at specific stocks, get going with a Map Signal subscription. Click into the body of the description. We will show you where all this money is going. It's going into specific stocks. 2024 is set to be a big year for stocks. Don't follow the doomers. Follow Map Signals. I'll talk to you next time.